Welcome back to Synaptic Dividends. Today, we're digging into a real giant in the energy world, NextEra Energy, ticker symbol NEE. Now, this one is a huge favorite for dividend investors, but we're going to look at the numbers and see if that reputation is really deserved.
So we're asking a pretty simple question today. Is NextEra's famous dividend a high-growth machine you can count on, or is it secretly running out of power? Let's dive into the numbers and find out.
All right, so the very first thing you need to know about NextEra Energy is that it's part of a really exclusive club. I mean, its foundation as a dividend payer is just about as solid as it gets.
And this number is why. 31. That's 31 straight years of dividend increases. You know, that's what earns it the title of Dividend Aristocrat, which is a big deal. It means they've proven they can raise that payout through good times and bad, year after year after year.
But, being an aristocrat isn't just about sticking around for a long time. For NextEra, it's really about powerful, consistent growth. Let's take a look at the track record to see just how fast this thing has been climbing.
And check this out. The consistency here is just incredible. Whether you look back 10 years, 5 years, or just this past year, the dividend has been growing at a powerhouse rate of around 10 to 11% every single year. Now that is how you compound your wealth.
And get this isn't just ancient history. Management is so confident that they've actually come out and said they're targeting about 10% dividend growth per year for the next couple of years. That is a really bold promise to make to your investors.
Okay, so far this looks like the perfect dividend stock, right? Elite status, amazing growth. But when you look under the hood at the cash flow, you find something that, at first glance, looks like a gigantic red flag. And it really makes you wonder, with all this growth and these huge promises for the future, where is the actual cash coming from to pay for all this? The answer, well, it might actually surprise you. Okay, just look at this. The free cash flow payout ratio. Now, that's the metric that tells us how much real cash is left for dividends after all the bills are paid and all the investments are made. Well, it's been negative for years. I mean, the company is spending way more cash than it's bringing in. For a lot of investors, that's a 5-alarm fire. But here's the absolute key to understanding NextEra. It's not what we'd call a harvester company. A mature business that just spits out tons of extra cash. Nope. NEE is a builder. It takes every single dollar it can find and plows it back into massive new growth projects, like huge solar farms and wind turbines. So that negative cash flow, it isn't a sign of weakness. It's a sign of enormous ambition.
So because it's a builder, free cash flow is just the wrong tool for the job here. We need to use a different metric, the net income payout ratio. This looks at the dividend compared to the company's accounting profits, and it gives us a much clearer picture of what's really going on.
And boom, here's the real story. The dividend only uses up 61% of the company's profits. That means there's a huge margin of safety. The dividend isn't just covered, it's well covered, with plenty of profit left over for both those dividend checks and that massive reinvestment plan. So, let's put all the pieces together and answer that first question we had. That scary-looking negative number we saw? Well, it's not a bug in the system. It's actually a core feature of the company's high-growth strategy.
So, the bottom line is this. What we have here is an elite dividend aristocrat with a really powerful and consistent 10% growth rate. That negative cash flow we saw is just the fuel for its growth engine, and the dividend itself is super safe, comfortably covered by profits.
So, back to our question. Is NextEra's dividend running out of power? Far from it. The numbers show this is a high-voltage growth machine, and that negative cash flow is just the investment that's powering its future.
If you want to go deeper and understand the full business model, the competitive advantages, and the management behind these numbers, check out our long-form podcast analyses on our channel, Synaptic Investing.